one of the greatest things about farming in this country is that we are on a completely different time frame as the Northern Hemisphere. It is very common to go into April, May, a frost in Russia, a drought in the US, something happens in that critical spring period for the Northern Hemisphere, and it kicks prices up and everyone gets in a frenzy. We see it over the last 5 or 6 years, it's probably happened 4 to 5 times. And then harvest starts and all the tons start hitting the market and that rally unwinds. And so you just don't know what is going to happen. But if we use history as a guide, often we see these rallies pop up and all the really sophisticated across strategic growers take that advantage. A lot don't. And then the prices dwindle off and you're stuck at harvest time, sort of begrudgingly accepting a price that you're not happy with.
Welcome to the Profitable Farmer podcast, where we share stories and tips to help you run a better farming business and create your very own freedom farm. If you're looking to work smarter and not harder in your farm business, welcome. You're in the right place.
G'day team, hope this finds you well. We've had 46 mil here, which for us follows up a pretty positive February and March, a lean April, but this really does set us up. So it seems like it's been a very general rain, and I hope it has found you and making positive inroads to your season. About 8 months ago, in August last year, I interviewed Brett Stevenson from Market Check. Now, Market Check, as I think you may know, is Australia's biggest and most respected grain marketing company. Brett is its founder, and I think he's led the charge there for over 34 years. And he made some pretty compelling and challenging predictions, if you like, about how he felt the grains markets locally and globally were going to unfold back in August. So I thought it was really timely that we connect again. And so in this episode, and on the back of episode 174, which I encourage you to go back and listen to, headed, "There's nothing that beats high prices like high prices," I thought it was timely to grab Brett again and his CEO, Nick Crundall, who has worked with Market Check as an advisor and now their business leader for 10 years, just to check in post Iran-US war, post uplift in fuel and fertilizer prices, what's changed in the grains market. And what they encourage us to do is not to sit on our hands and wait until harvest, but there's an opportunity, they think, right now to take advantage of. And there's also the opportunity to take some risk off the table and be really proactive by defining a marketing plan, locking it in, getting it on paper, and being disciplined and proactive in our decision-making over the coming months and in the lead up to harvest. So enjoy this. I hope you find it insightful, and I hope it inspires some proactive action from you as you shape for this season. Brett, Nick, thank you so much for your time. Great having you again with us, Brett, on Profitable Farmer. How are you?
I'm excellent. Thanks, Jeremy.
And Nick, first time on Profitable Farmer. Thank you, mate. 10 years with Market Check as CEO. Congratulations. What do you love most, mate, about being part of the Market Check team?
Yeah, I came in at a lower rate position, but I've since become CEO in the last couple of years. I think my favourite thing would be just the unified vision that we all have. We only work for Australian growers. We don't have any other axe to grind. Every day that we come in as a team, we've got a really young, energetic team to work with. We have one goal, and that is just to advise and execute for our growers the best we can. So that's always been a huge plus for me to stick around with Market Check, because there is no two ways around why we're here. We're purely here to service our clients.
Thanks, Nick. Brett, chatting on this podcast in August last year, now 9 months ago. A lot's changed, but I think if we go back to 9 months ago, you gave us your predictions on how you thought things were going to play out. Would you mind just reflecting back on what you said and maybe then just commenting on, did that actually play out?
Thank you, Jeremy. And the 9 months ago, we could have both had another child between back then and now. Anyway.
Thank Christ neither of us have, Brett.
No, that's fine. I think I'm a bit long in the tooth for that. But anyway, look, the world has moved a bit since I last spoke to you. But just for the sake of the listeners to review, what I was talking about to you last time was the fact that since the Ukraine-Russian war, well, let's put it simply, Russia invaded Ukraine and caused a complete, step jump in the world in terms of supply, because we've got number 1 and number 5 producers being affected dramatically by being at war with each other. And we saw that reflected through the almighty price increases of a lot of things, oil included, which we're seeing now, of course, again. But grains, particularly because of that issue of number 1 producing country and number 5 producing country fighting with each other and causing all sorts of logistic issues. And what I was explaining was that those high prices have drawn in a lot of new production into the global paddock, if you like, and because it made, at the time, grain farming very profitable. And I was alluding to the fact it was a little bit like the wool boom back in the mid-50s, only we probably don't recognise these things until after they're gone. But the issue was, for me and for growers, is that by bringing in a lot of new hectares, and to give you since then, some analysis has shown that something like 900,000 hectares in Victoria alone have gone to grain production out of sheep and cattle production in the last 5 years since the war. It would be 4 years, I suppose you'd say. So that's just a little microcosm of what's happened globally. And what we would see is, therefore, with that average production cycle, we'd see that those extra tonnes coming to the market would be too much for the market and would sustainably hold it down until we could drive acres back out of the production cycle. So I was sort of saying that we're going to see low prices for some time, and growers have got to get used to it, understand it, and manage their affairs accordingly. And that has certainly been the case. But since events back in end of February, we've seen a short change in that environment.
Thanks, Brett. Nick, what's changed over the last 9 months from your perspective?
Yeah, so I suppose to start, nothing had really changed up until the end of February. So to Brett's point, one of his main arguments was that input prices were remaining stubbornly high back then, and unfortunately they look low if we look back on them now, but at the time they were high and commodity prices were low, and that was the environment in which Brett was suggesting growers need to become pretty comfortable in.
And just to jump in, Nick, like we talked about, Brett, that declining terms of trade and the cost price squeeze were constructs that we haven't talked about as an industry since the 90s. And I think, Nick, to your point, we started to get a sense that that might be the new outlook, right?
Well, that's exactly right. So we fast forward, went through harvest, prices were pretty lackluster. We had global prices chopping along the bottom. It was all pretty bleak to Brett's, sort of premonition. And then we obviously had that US-Iranian conflict flare up at the end of February. Now, unfortunately, it actually puts a microscope on what Brett was talking about, because the dynamic between inputs and outputs has actually gotten worse. So, for example, easy example, fertilizer has doubled, if not more. Diesel doubled for some time, whereas the prices that we're seeing in global wheat markets or domestic wheat markets, for that matter, haven't gone up by anywhere near that sort of quantum. So those dynamics are as bad as they've been for some time because of what's happened. But it does change the outlook somewhat, which I'm sure we'll get to.
Brett, another comment on what you spoke about and have seen play out?
Yeah, well, the thing was, just for instance, in terms of what Nick was talking about, is that we saw probably one of the lowest volatility price systems at harvest price during the harvest period, very, very low volatility, virtually nothing happening, which just suggested that, and internationally we saw very low volatility in prices, overhang of production, just keeping the market down. And canola would only be the only one that was a little bit better. But generally, all markets were pretty overwhelmed by the supply carryover. So that was pretty much in the market. But of course, Nick alluded to, once we got to the war, and it was even happening as well, you had a confluence of two things happening, and that was dry spring conditions starting to emerge in North America, principally Kansas, and then the war and the impact of the war in terms of the oil prices and a lot of other gases, and gas principally because a lot of urea comes out of that area of the world. So urea sort of once gasping at $600 to $800 a tonne, now getting used to $1,200 a tonne. Input prices have got worse. But there's a lot of things. I'll let Nick talk more about it, but there's other things that have happened. It's brought in fund money into the commodity game again because there's talk of growers not producing enough food for the world because of high diesel prices and high urea prices ceasing production. And that sort of fear has enlightened the market, and we're now seeing some real volatility in prices internationally. We're not really feeling them so much here in Australia, but they're certainly happening offshore. In America, not so much in Europe.
Thanks, Brett. So, Nick, what is the impact that you're seeing playing out between Iran or as an outcome of the Iran-USA conflict?
Yeah. I mean, this is obviously subject to change. We haven't got a resolution at this point, but I think twofold that we're seeing. One is obviously on the input prices, and it's our expectation that these input prices that we're seeing, whilst they might succumb to some level of pressure, if there was a resolution, we are going to have to get comfortable with higher inputs for longer. We have damaged critical infrastructure in certain parts of the world that create fertilizer. The Strait of Hormuz is not going to open instantly the next day. Everything's available. It's all good. There is a huge backlog in terms of different chemicals and fertilizer that need to get to market. It takes time. So the first thing is that we will see an impact last quite a while in inputs. And that will, in the medium to longer term, impact global production to some degree. There'll be less application of fertilizer because it won't be available, and all the price sensitivities don't allow it. But the other thing that we're seeing, which is a little bit more for those who really watch markets, is what Brett was alluding to, and that is the amount of capital that's flowing into grain markets, specifically in the US. So if you go on Twitter, which I don't recommend any listeners to do, late at night, you'll see an abundance of headlines about the world quickly running out of food and this global panic that's going to begin. Inflation is flaring back up, which is very true. But what that is doing is that it's redirecting large pools of capital that wouldn't otherwise be interested in wheat, corn, soybeans, all the futures markets that we look at, are now really having a look at agricultural commodities and directing a lot of that capital into those markets. And that's exacerbating these moves. So keep in mind that the US is a major exporter, but the conflict in Iran, in terms of grain flows, means absolutely nothing. But the Russian-Ukrainian conflict was, as Brett said, the biggest export in the world, invading the fifth biggest, and it cut the Black Sea off. That is an absolute Armageddon-style situation. Iran being cut off for grain flows really doesn't mean much. But what it does is it heightens all this mania around potential impacts in the future. Oil screams higher. There's a correlation between oil and grain markets, and you see a big influx of what we call fund money into the markets.
Nick, is that money flowing into the commodity markets and they're participating, that it's not capital flowing back into acquisition of farmland?
Yeah, that is capital going into the futures exchanges, nothing to do with the physical land, and just buying wheat or beans or corn in the hope that prices in the future will go higher. And we've seen an enormous push of capital into these markets for the last 2 months in the view that prices are going to go higher because of the conflict that's happening in Iran at the moment.
Brett, what's your view on how that might not distort, but influence pricing?
Well, what it's doing is we're seeing it's been exacerbated by the fact we've got dry conditions in North America. So we'll focus on North America a bit. Nick will kick in a little bit in terms of Europe and what's happening there. But North America is going to have, I think, Nick, if I'm correct, one of the smallest crops it's going to have for 50 years this year. We're in the spring there. We've got the hard red winter and the soft red winter crop to come off yet. Probably Texas might be just starting, but we're very early stages of that. And so they've had a very dry spring. And so that was in the market in terms of the people within the world of grain industry within North America. And then what happened was we got the money flows that Nick is talking about, wanting to vest themselves into the grain industry, and by that means buy into the grain industry in any way they could, and futures markets are the predominant way they do it. And so we had the fear of the drought and what that might do to stocks in the globe as well as the US, supplies within the US coming into the market at the same time money flows were coming in. And meanwhile, we had our own Australian growers down here, dealing with dry conditions in the northeastern grain belt as well. And so there was a few sort of things happening. We didn't see that resulting. There's no money flows coming into Australian futures, so we don't see them buying into the ASX. But we did start to see a move upward in prices here in Australia, but nothing like the sort of volatility we've started to see in America. We're seeing last night, to give you a little window, we saw the market come in and out of a range of about 25 cents a bushel. That's, roughly for Chicago futures, not the same for Kansas, but both of them are moving around by the same amount. If you put that in Australian dollar terms, that's probably $3.60, $7.10, $10 to $15 a tonne movement in a night. And we're seeing similar volatilities happen in the futures here during the daytime in Australia, unheard of really from before. So we're not seeing that reflected. So the Australian grower is sitting with stock and managing their way and thinking that it might be the northeastern Australian drought that's causing the lift in markets. But it's a bit of that, and also the fact that we've got these two events happening offshore, money coming into the markets as well as dry conditions in North America.
Brett, what else do we need to know about that corporate capital investment into the futures market and also what's playing out in America?
Well, what we do know, these things come and go. So we see the fund's ownership of the market is going up at present. But as soon as they feel there's no need or no potential reward, and one of the big things that's happened is, and I might just use an analogy, in the horse racing industry, what's kept the horse racing industry going is that they've retailed the dollar for buying horses, as you might know. Not to say I'm a big horse racer, but I know people who do have them. And you can go onto the web and you can buy into a syndicate for as much as, like $500 or $1,000 and own 1/50th or 100th or 1/200th or 1,000th of a horse. And you can be in the game to try and win the Melbourne Cup or whatever you might perceive your objectives are. Now, putting that in context with wheat markets for the Australian grower, you can almost similarly do that in terms of investing in commodity funds in America to access those markets. And so it puts a very retail context. It's not what people think. People might think it's a guy sitting in New York that's moving around his own money. We're getting these big washes of money that come through because of the internet changes things. You've got mums and dads and everybody saying, gee, there's not going to be any food. How do we protect ourselves? How do we make a buck out of this? Coming into our markets, driving prices up, and then finishing off their order, and the market falls back down again. And, another one comes the next day and another wash of funds. So it's a pretty crazy environment, but you've got to understand what's going on. And these people don't necessarily know the full dynamic of the market. And the fund manager's not going to say, look, don't invest because we think it's unlikely you'll make a quid. The great American fast buck way is put your money in, we'll vest it, and we'll see how you get on. So that's something which I think growers need to be conscious of and mindful that, because there is a certain element in an Australian grower's mind that if the market goes up in America, someone knows something, and therefore I should be wary because they got more information than me. I would strongly warn against thinking that.
Nick, what else do we need to know from a global perspective?
Yeah. So Brett's touched on the sort of capital coming in. If we look at just the fundamentals of the global market, so I'm talking supply, demand. Part of the reason why Brett and Market Check, broadly speaking, were concerned about prices back last year in August was that 2025 was a record year globally for wheat. I mean, it was just out of the box big. Almost everyone had a record. Huge growth in the level of stock sitting around the world. And that was a really primary concern that we had, keeping prices weak. If we fast forward now, and for anyone who's not quite across the wheat markets, the Northern Hemisphere harvests in June, July, August into September in some areas. The Southern Hemisphere, obviously predominantly Australia and Argentina, is a little bit later at Christmas time. 90% or thereabouts of the global wheat production is grown in the north. So you're talking about to the tune of 700 million tonnes. I'm rounding here, so don't hold me to these figures, but you're talking about 700 million tonnes in the north, the hemisphere, comes into harvest around sort of the June to August period. So fundamentally speaking, to go back to your question, this year we've seen a cooling off in production globally. Now, we've seen places like the US that Brad alluded to, worst crop in about 55 years. Absolute disaster. No getting around it. Argentina's coming off a record. Australia is forecast to be back 6 or 7 million tonnes. So there is just fundamentally less wheat being produced in 2026 as there was in 2025. Now, what does that matter? We're seeing about a 50 or just shy of 50 million tonne drop in production in just the major sort of 6 major exporting countries for wheat globally. It sounds like a lot, and it is. It's 1.5 times the average Australian crop or thereabouts. It's a big amount, but we are coming off a very high base. So looking forward, we are basically seeing a drop in stocks globally of about 11 million tonnes as a result of that lower production. So the stock levels coming back. But again, they're only coming back to about 5-year average levels. So we've gone from a world in which we had an abundance of wheat, which was what Brett's primary concern was back in 2025, to one that's a little bit more balanced. It's not to say there's a shortfall. I absolutely reject any call for panic around food security almost anywhere in the world. There is ample wheat that is going to hit the bins imminently, but we are in a world going forward where those buffers that we had last year have been reduced back to more average levels, which just makes you a little bit more optimistic for prices going forward.
It's a great insight. What does that mean for Aussie growers, and what's the sort of national production outlook looking like this year for us?
Yeah, I'll tackle the second first, and then we'll talk about what it means for Aussie growers. The USDA, which is pretty much the global benchmark for forecasting crop sizes, whether you like them or not, is pegging Australia at 30 million tonnes for wheat. That is just over the 10-year average. Last year was 36, to give you a bit of a reference. So again, you see these headlines about Australian production plummeting 6 million tonnes, and you think, oh, it's a disaster, but it's only coming off a very, very high level. So the market, I would say, is working on a production for wheat around 28 to 30 million tonnes. Now, that's assuming average conditions from here. That's a strong crop. That's still a pretty reasonable crop. If we do see this El Nino emerge, if we see a tough spring, certainly some area, like some room to move that production estimate down. But that is what the market is trading at the moment in sort of mid-May. So what does all this mean for growers in Australia? Firstly, we're seeing an opportunity based off this conflict, which may continue for the foreseeable future. But there is an opportunity in the market that is present right as we speak today that wasn't there 8 weeks ago, that may not be there in 8 weeks' time. And that is this big rally in US wheat futures. All this fund buying, this war premium, They're concerned about the US crop. The US price has gotten so high that they're actually importing Polish wheat into the US, which is very, very rare. That's how high the US prices are. This is what the funds do. They push a fundamental issue to just another level higher. So for growers, I suppose what it means for them is we have a tighter global outlook in terms of supply, which is the good news. We should see some level of base prices being a little bit higher now relative to 12 months ago. But the immediate opportunity is that growers are being offered prices that they would have killed for 2 months ago before the conflict started. They were waiting for a rally. And so what it means for growers is they need to be proactive in capturing the opportunity in markets that exist today that just may not exist in the coming days, weeks, or months. We just don't know what the sort of conflict is going to do. But we do know, for example, that Northern Hemisphere harvest begins within a month. We do know that hundreds of millions of tons are going to hit the bins in the Northern Hemisphere in that period. And therefore, we need to be proactive in taking some risk off the table.
Yeah, and to your point, Nick, fear in the market, that doesn't always last a long time. So maybe that opportunity that you're talking about is a short-term opportunity.
So just to add to that, Jeremy, if you go back over the last 5 to 7 years, and again, I'm paraphrasing a little bit, it is quite common. One of the greatest things about farming in this country is that we are on a completely different time frame as the Northern Hemisphere. It is very common to go into April, May, a frost in Russia, a drought in the US, something happens in that critical spring period for the Northern Hemisphere, and it kicks prices up and everyone gets in a frenzy. We see it over the last 5 or 6 years, it's probably happened 4 to 5 times. And then harvest starts and all the tons start hitting the market and that rally unwinds. And so, again, to your point, you just don't know what is going to happen. But if we use history as a guide, often we see these rallies pop up and all the really sophisticated across strategic growers take that advantage. A lot don't. And then the prices dwindle off and you're stuck at harvest time, sort of begrudgingly accepting a price that you're not happy with.
Yeah, Brett, what's your comment? And what advice, I'll come back to you, Nick, if I can, on what advice you're giving to your growers now. But what's your comment, Brett?
I was just going to mention we've done some detailed analysis just lately because of this strong rally. What has become is statistically apparent is over the last 5 years, the probability of the price that you lock in being the highest price, the highest probability month is May. April and May are both very high probability, but May is the highest probability. It doesn't mean it is, but it's got the highest probability of success, April and May, compared to all the other months. And once you get to September, October, November, you're in the lowest probability months. The trouble is their crops are just going in the ground now, so it's hard. And I'll let Nick talk to that effect. But that's the reality of the last 5 years of market movement.
Thanks, Brett. Nick, what is the direction strategically that you're extending to your growers at the moment?
Yeah, so firstly, this is general in nature. We do have a Australian Financial Services license, so this is not specific advice. Yeah. So Brett is on that license, so he'll breathe a sigh of relief hearing that, I'm sure. Look, I'll be general. Our advice is very straightforward, and that is that growers need to use the current rally in the US market to their advantage and take some risk off the table. Now, if you have no experience with hedging, maybe you're not sure about it, you're not set up, certainly there is avenues in which you can upskill. But in general, our view is that we should be taking some risk off the table. Now, if you're in Victoria and you're holding on to some old crop, or if you're in the north and you're sitting on a bunch of crop from last year, or if you're across your new crop and you want to start hedging, any and all cover, I think, is a good opportunity here. We've seen prices rally domestically. We've seen market rally aggressively offshore. Our general advice is that growers need to pick the phone up and get proactive on this rally and take advantage of the higher prices being made available to them now relative to only 2 months ago.
Brett, what would you say to a grower that has been bitten trying out hedging or futures in the past when they hear sort of a comment like that? How do we encourage people to dust themselves off and actually have another go?
Well, for a start, I've been in the game for 34 years, Jeremy, as you know, and I have a lot of growers that have been with me for 34 of those 34 years. Families, I should say, and they're successful families. So the thing is that consistency is a virtue, and a bit like the share market, when you invest in the share market, maybe it falls, or maybe it rises, but over time, it's been proven that it actually outperforms just putting it in the bank. And that's a bit about like what we're talking about. We're not talking about hedging a whole crop or a huge proportion of the crop. We're just taking some risk off the table. And I mean, selling old crop stocks, that's not risky. That's just turning the crop into money. But when you're talking about hedging using swaps and that sort of thing, look, the market could continue to go higher. It could go higher. There's a lot of different things that could happen. It could go higher, and therefore you feel like, oh, gee, I buggered it up. I should have waited. Or it could go lower, and you think, shit, I should have done more. Or it could do very little, and you wonder why you even did it. The thing is, when you're putting $1,200 urea in the ground and you're putting $3 a litre diesel into the tractor, you've only got to sit down with your gross margin analysis to realise that if it does fall, you're going to fall into loss pretty easily. And so if the market is offering something that's giving you an opportunity to take some of that risk off the table, whether it goes higher or not, it's quite sensible, I believe, and we've been practicing it for a very long time, to take some of that risk off the table. Now, if it goes high, you've got other crop left to participate. So the thing is, what's been wrong with the swaps as a risk tool is people have expected to make money out of them. And there's a lot of growers, nearly 3,500 of them that have been to my workshop, and a lot of them will remember me saying, hedge to lose, sell and repent. Sell and the market goes high, no problem. Well, that's great. I've got more to sell. That'll be fantastic. Thank you very much. Don't go, I'm going to try and pick the high because nobody does. So it's been unfortunate that people think that the product relates to losses because it was badly used in 07 and 08. It's a long time ago now. I think the true professional, well, I don't think I know, the professionals who use them consistently know the validity of them, and they know that it outperforms forward contracts, and so they just go and do it. So I wouldn't let people talk themselves out of it.
So we're happy to share what I'm about to go through with your listeners. We've done the analysis on two primary things, basically, and I'm talking about pre-harvest marketing. So if you sit between March and June, pre-harvest, in that sort of sowing window, we've basically gone back and analysed if you hedge in that window using Chicago Board of Trade CBOT, if you're a hedger, if you hedged some of your new crop, or you decide to do a forward APW multi-grade into your local site, which one outperforms the other? So the decision's been made to sell. You can either sell physically for new crop delivery, so December transfer, or you hedge offshore and then unwind that hedge at harvest and sell physical. What we've found out, and a lot of what we do at Market Check, everything we do is around probabilities and using them to our advantage. Essentially, there's been about 2 or 3 years in the last 15 plus that forward physical sale has been a better outcome than hedging. So again, when you talk about clients that have been hedging and consistency, you'll have one that will come in, and unfortunately in that year, maybe it was line ball and they think it wasn't worth the hoopla. But in the last 3 to 4 years, there's been somewhere around $30 a tonne, if not more, of extra return for those who hedged versus forward selling. If you go back about 18 years, it's $25 to $30 a tonne, give or take, better than just calling up and doing a forward sale. Now that it's a huge sample size. It's got all these other benefits, which I won't go through. But the ones who consistently do it are being rewarded on average by this quite significant amount. And then we weren't quite happy with that analysis. So we thought, well, let's pitch that against someone who does nothing. Maybe just don't sell anything pre-harvest and just hit the bid at harvest. And even there is a significant outperformance hedging during that March-June period, so where we are now, versus doing nothing over a 5, 10, and 15 plus time frame. So I'm certainly not saying this year is going to be, it's just a lay down misere. That's definitely not the question, but the statement I'm making. But what I'm getting at is growers who invest the time to learn this stuff, quickly learn the tools that they typically have been using are the issue. And there are tools available to them that can better their outcomes. And I'm very happy, as I said, to share that analysis to your listeners because it really puts it in stark contrast about the default weapon for growers being forward sales is just dramatically underperforming hedging. But again, you do have to deal with some level of volatility year to year, but over the long run, it's unquestionable. It's a fact in the last 15 years that there's been a significant outperformance.
Nick, I'd love to share those or that piece of analysis in the show notes. Thank you. And I guess just expanding on that, and you've mentioned the better operators, the more professional strategists around their grain marketing. What frustrates you about what the rest are doing? What are the 2 or 3 mistakes that you see the majority making that those professional few are absolutely nailing?
Yeah. Okay. So look, there's a couple of things that if I could solve in my career, and I think Brett spent most of his trying to solve this, and I'm taking that baton on a little bit. It is the psychology around what growers are doing. So what do I mean by that? Basically, the growers that we deal with, that we can really, sort of work with year in, year out, that are the top performing guys, manage their risk. They're not trading for a high. They're not saying, okay, let's sell it today. This is definitely going to be the high price. They are purely managing risk. So the big mistake that we see by a large portion of the grain growing community is they're just not conscious of the risk. They aren't looking at markets. They're not realizing that the 60% of their lentil production, and lentils is a good example I can go into, sitting unsold in the market in June is just an overtly risky thing to have exposed in your business. If the market falls $50 a tonne, that can plunge you from a good season, as you well know, Jeremy, into an absolute disaster. So not managing risk, not having that risk management focus. Okay, I've got 100% of my crop exposed. Let's take a little bit of risk off. If prices fall from here, look, we've covered some, so we've got some risk off the table. It would be so much of a shame to see that happen, but at least we're not fully exposed. If prices go higher, don't kick yourself and wake up at night regretting it. You've still got a huge portion exposed. Great. You always want prices to go higher. Just have that mentality. That is the single biggest mistake I see growers make, is they go into that trading mentality. I think the other one that comes to mind, and Brett, you've got double the experience that I do, that you might have another one, but is not separating cash flow and tax from markets. So I know right now there is a big collection of growers predominantly sitting in Dubbo North. Now they are doing it tough for this season. I make a lot of concessions for that. The market has kicked from harvest to compensate for this tougher season somewhere to the tune of about $130 a tonne, maybe even more. That's how big the move higher has been. And yet there is a power of wheat that will not come to market. And that is growers unwilling to sell. They think it's still going to go to the moon. And I can talk about why that's not going to be the case. They're not aware of the broader dynamics. They're just looking locally, which is an issue. But secondly, they're thinking, well, I can't sell until the 1st of July because the tax man will come after me. Or an example would be they get to harvest and go, oh, crikey, I've got no cash. I better just call up my local merchant and just sell everything. And that just kills me. It honestly it keeps me up at night, because there are so many ways in which we can separate that decision. I'm sure you guys talk a lot about it at Farm Owners, about how you separate that decision. Sell when the market is right, when you see an opportunity, and sort your cash flow separately from that, because you can separate them. So I think for me, risk management and separating the decisions around generating cash from your cropping away from a need to do that or a need not to do that when it comes to those who are trying to defer income.
So many trying to minimize and avoid paying tax. And there's another podcast that we'll share in the show notes that I did with Jeff McDonald, which is just average decisions at tax time. It just blows my mind how many people are deferring, capitalizing on those good prices or buying plant that they don't really need or whatever it is in the lead up to 30 June. Please, guys, if you're listening, don't make strategic decisions based around minimizing tax. It's exactly the wrong focus for us as business owners. Brett, your comment?
All I was going to say, Jeremy, is that when I started back in 1994 with the growth in the Eastern Australian domestic demand industry through feedlotters, piggeries and everything else, the amount of domestic market available for growers has grown and grown and grown. We've got 1.7 million cattle on feed at the moment. Not so long ago, we were thinking we might reach 1 million. Anyway, where I'm getting to is that I was a very strong advocate for building on-farm storage because of the logistics nature of increased speed of taking the crop off and the inability to get it into grain corp or whichever site you might go to. And then with a lot of the grain being executed into the domestic market, it didn't make sense to drive it off 30, 40 kilometres and then it'd have to be shipped then to a feedlotter or something like that. Much easier to keep it on farm and execute straight from the farm, save all the freight, make it a much easier execution process, albeit that you have to look after the grain. Now, where I didn't think would happen, but has happened, is that I expected people to be, in doing that, to behave in a more systematic manner to manage the risk of that grain once it's been stored. Because the other trend is to warehouse the grain in the sites, in the official sites, until harvest is complete and then start selling it after harvest once you get time, once all the hubbub of harvest is over. But what people have done in the majority, not the minority of the professional growers, in the majority is they then get it in there and they treat it as sort of two manners, and Nick might have comments about this. They either sit on it like a giant egg, right, waiting for a Russia conflict or something to happen to blow the price out of the sky and then believe that they'll sell at the right time. And some of them have got reference points that somebody in the local area actually sold their grain for $500 a tonne or something. And they'll think, wow, if I just hang on to it long enough, that'll happen to me. And the other one is they treat it like a bank account. They say, oh, let's not monitor the market, but when we need a bit of cash, we'll just sell a bit of grain. No reference point to risk or the market or anything like that. They say, oh, the bank's run, we're a bit short of cash. I see a bit of overdrafts building up. I better go and sell some grain. No references to whether it's a better time to sell or it's the right grade to sell or anything. And so I have created a bit of this problem by the advocacy that I've done for on-farm storage. But I think I said it in the last podcast, what people need to do is, in terms of making differences to improve their situation, is just better manage, like Nick is saying, what they're doing with their risk and marketing of the grain. Don't try and think that once you get into grain storage, be it warehousing or on farm, that there's some nirvana to be found. There's not really. There's improvements in logistics constraints and costs and things like that, and ability to blend and all those sorts of advantages. But it's not about turning a $50 a tonne grain into 500 or something like that. And I think that's a real misconception that's out there. The media has been a part of it because a lot of the advertisers have been grain storage companies and the like.
Thanks, Brad. Nick, a mentor of mine sort of once challenged me to ask this question whenever I sort of came across a problem, and it's by what method do I solve for that? If you're suggesting that consistency is key and that people need to have almost like a grain marketing policy that's documented, that is the basis on how they're going to do it consistently year on year, can you think, and even without naming them, like that outlier superstar client, do they have a policy documented for how, the method by which they are consistent with their grain marketing? Or what is the fix here that people can give attention and energy to try and bring consistency to their approach?
Short answer, yes, there are those clients. What are they doing? you kind of answered my question a little bit. Firstly, they know they have a document in their business that details the level of risk that they're willing to have in their business to grain markets. So it might say something like, I never forward sell or forward hedge or do anything pre-harvest up to 50% of my minimum crop estimate before September or October. It can be whatever month you want. On the flip side, I never go into harvest completely unsold, everything swinging. That you just have some guardrails. You never emerge from harvest with 100% unsold, or I never sell more than 20% of my production on any given day, no matter what the opportunity is. Because you see people get really overzealous and this is unbelievable. And they're not quite aware that the market's got some real legs to it and they regret that. So you have a plan. That is one. The first thing is they have some rules that are set in stone in their business that they stick by. The second one is they understand the environment and tools in which they have available to them. So what do I mean by that? Essentially what I'm saying is they know if they're in a bullish or a bearish sort of construct. You don't need to be across the latest USDA numbers. That's my job. That's what I love doing. And that might be, the worst idea for a grower, worst thought of a grower trying to do that. They'd hate doing it. I love it, right? So, but they need to know what's happening. Broadly speaking, they need to know that when Russia invades Ukraine, that's a seismic impact to the market. They need to know that the North is really struggling and a lot of that production that came online, if we use an example off the top of my head, like canola, huge acres of canola Dubbo North in the last 2 or 3 years. Bonanza, almost gone to zero. Now that has implications. They know the general flow of what's happening. So they've got a plan. They know the general construct of the market in which they're operating. And lastly, they have a familiarity with the tools that are available to them. So an example would be, am I going to hedge or am I going to forward physical? That's an easy one. Another one might be, I've got on-farm storage. I don't need money right now, but I see the risk. Prices have rallied well. I might sell. Okay, well, you're sitting there, maybe you're 100 kilometers away from Hamwood, big Biata sort of domestic user, or you're on the Darling Downs, or you're in SA and you're near Wosley's, where the Ridley's mill is. And you can sell into that market, but maybe you sell for July, August delivery because they're going to pay you $10 a ton to defer that delivery for 3 or 4 months. And that you have to take into account the costs of storing and interest. But often the market will pay you more than it's going to cost you. And so they'll do that. They'll sell a little bit further into the distance. They'll pick up a little premium. And it's those sort of decisions they make every time they engage with the market that over time compound. So they have a plan. They're aware of the dynamics of the market and they're aware of the tools in which, or the avenues in which they have to engage with the market, would be my 3 things on that.
I might just add a fourth because by definition, if they're clients of yours, they're also getting access to the best intelligence that exists. Like that's got to be number 4. And I think there are really 4 key points. I like the construct that if it's in my head, no one can help me make it happen. And if it's in my head, I can only be reactive, right? And so to your point, if we can get it down into a policy with some really clear boundaries and rules that links to a plan that's based on the latest intelligence, we have to be more proactive and we have to be more effective. Thanks, Nick.
And it does speak to the advice. We are an advisor and we have strong advocates, obviously, for growers to outsource some of the work here. But take back 2 or 3 weeks ago. So we're sort of start of May, April, May, Darling Downs feed market had rallied, as I mentioned earlier, gone to the moon, about $130 a tonne since harvest, even though harvest was about the second biggest on record. So there's no shortage. It's just growers are sitting on it. And good on them. The market's gone through the roof. They've really benefited from that. And so we put out a thing to our growers. I'm talking about knowing the construct of the market. And I said to our members, hey, we've rallied up to a point where you can actually buy a cargo in WA of wheat, put it onto a ship it round to Queensland, unload that wheat and service the Metro Brisbane market. And we're only $15 to $20 a tonne away from that grain also the spread between the two markets being so wide that you can also get off a boat in Brisbane and take it up into Dalby and the feed markets. So you're essentially at what we call import parity. And therefore, even if conditions get even worse, the market is going to struggle to keep going up because you're actually more exposed to what happens in WA and SA. If they go up 20, Queensland will go up 20 to keep that spread there. But equally, if SA and WA fall 20, your conditions could get worse, but your price might get worse with it, which is a disaster. And so being aware of that, and since that publication we put out, we've seen a cargo rumoured to be done, and the Darling Downs market has fallen about $20, $25 a tonne. And again, it's just knowing that you can't be across everything, so you need help, but just understanding the dynamics. Oh, okay, the market's gone up by a lot. I need to understand, where is WA wheat? Are we close to import parity? Again, similar example, I won't labour on it. Manildra in the last drought importing Canadian wheat. I mean, there was growers holding on to this stuff in the worst drought we've had in 100 years, thinking it was going to go to $1,000, and all of a sudden, Manildra, this isn't a secret, Manildra started importing wheat from Canada and the price fell like a stone. And again, it's just being aware that these things, it's a dynamic free market. So again, to your point, you just need to be aware of the general constructs in which you are exposed to, and having an advisor is a very good way of at least making sure someone is looking at this stuff full time.
Thanks, Nick. Just to change direction a little bit, you mentioned 30 million tonne being our production forecast presently. What have you seen happen with that spike in fert and oil prices, etc.? What have you seen play out? What's happening on farm in terms of people making adjustments to their rotations and simplifying their systems to manage their cost base? And what flow-through effect is that having on the national outlook?
So we surveyed all of our members not that long ago, saying exactly the question that you've just asked. We don't release that outside of our member network, but we can talk broadly about it. I mean, speaking specifically, wind down of canola acres, winding up of lentils, lupins, hay, vetch, stuff like that. The most interesting thing that I found was, despite the deteriorating economics of growing crops because of the inputs, it was a moisture deficiency that was actually the cause of the very large majority of acres being abandoned. Where the moisture was fine, namely South Australia and Victoria, there was almost no abandonment of acres. It was a tweaking or a rotation out of particular commodities like canola and wheat, and more into barley, lupins, and other things like that. So we are seeing that. Our growers unanimously said that they had enough fertiliser on hand for at least the sort of initial window, certainly very well open in the back end. So to answer your question, we're seeing not much reduction in acres in Victoria, South Australia, big reductions in the north because of the deteriorating conditions. Just isolating the input costs, it hasn't resulted in what many would suggest is going to be this huge walkout on cropping. That hasn't been the case. If the moisture's there, typically something is being planted into it. Then when you talk about what are they doing, we're seeing more and more engagement on new crop cover and selling. But again, this is a minority. Many are sitting there going, no, it's a war. This thing's going to keep going up, and they're not willing to sort of do something, or, maybe they're wanting to wait a little longer, whatever it may be. We're seeing the proactive guys jump all over this rally like a rash, but the majority are still holding off. And I suppose one of my concerns is that if prices do come off, that we do end up paying the higher inputs, and then when we get time to sell it, maybe in spring, we're not getting the price that offsets that higher input, and we've lost the opportunity that we might have here today.
Thanks, Nick. Great comments, Brett.
Just one thing to add on what Nick just said at the last piece there is, unfortunately for us and some of the other Southern Hemisphere countries, we're the first ones to go in at $1,200 urea and $3 diesel, right? Apart from the corn crop in America, but we're the first ones. So We're the growers that are dealing with this very, very high input price environment. And that doesn't necessarily mean that by the time we get to November, December, who knows? Who knows where we'll be?
Thanks, Brett. We did our own piece of research or analysis for one of our key croppers when they were forecasting that increase in fert and diesel and other input prices. And a really important piece of analysis that we encourage everyone to do is how much does our grain price at harvest have to increase to offset that uplift? And for them, it was really, I think fuel's 6% typically of our spend or our income spent on diesel, and fert might be 12 to 18%, but they're not our biggest expense items in our program. And for them, their grain price only had to go up $6 or $8 a tonne to offset and negate the uplift in fuel and fert prices. And so they got on the front foot then, once they'd done that analysis, looking at how can they be proactive to achieve that uplift so that, back in April, they've negated the uplift in fuel and fert prices. So for anyone listening, if you haven't done that piece of analysis, I encourage you to do it. And then once you determine what the increase you need to achieve through more strategic marketing, then as we've talked about with Brett and Nick, get on the front foot and work out how you can start making those gains now with the sort of insights and strategies that Nick and Brett are recommending. Nick, a comment on that?
Yeah, well, I suppose we would always advocate that you at least have a pretty familiar sense of your cost of production. And whilst there's a lot going on around markets can move and things like that, I just don't think you go too far wrong in understanding that if the market is offering you a solid return for your grain production enterprise, to take some of that off the table. If you produced pencils and someone all of a sudden gave you an opportunity to lock in a bunch of sales at a particularly attractive return on your investment, it's just good, sound business. You just will be among the top performers and you will be consistently there for the long run, just taking those opportunities. Again, everything comes back to stop trying to pick the highs, stop trading your grain. You spend all year growing it, spend hundreds, if not millions of dollars into growing it. And then the focus shifts to, I'm going to try and pick the best time to sell all this, or I'm going to sell it now because the school fees are in and I need cash, or whatever it may be, and just incorporate some level of risk management around what you're doing. And I think you'll also find, to finish, Jeremy, is you'll find that the marketing actually becomes something that either you don't dread if you don't like it as is, or you actually quite enjoy because you take out the fringe cases of real stress. And yes, you might give up 1 year where you could have sold a little bit at a higher number, but lo and behold, over the time, you will find that your returns have improved dramatically, having that disciplined approach.
Thanks, Nick. Brett, you're going to love my last question. Given that you've dedicated your career to nailing risk management in the grain market, I always try and stay out of politics, but what's your prediction on what Trump's going to do next?
Well, for a start, like to put my mind inside his mind would be, I don't think I'd be the person I am today. But what I can say is, just from being around for a long time, is that these things, I've been through a number of wars. I was there when Saddam Hussein invaded Kuwait in 91 and went through all that volatility. I was working in the financial markets at the time. But these things have a habit of, over time, and it takes time, of working their way out. In this case, there's a lot of economic pain being paid by a lot of people in the world as a result of this conflict in Iran. And they all have obviously a lot to say about what's going to happen because of what it's doing to their people. So I'd probably, and I know I've probably been optimistic that we would see some sort of coming to fruition more quickly, but it's actually not been going very long. But it will be over. It will be over at some stage. Things will go back to some sort of normal order of play. There will be some overhanging effects of it, but it will go back to normal. So I just don't think this is the new normal. It will be over at some stage. So that's all I can say, apart from trying to jump into Trump's mind. He's a bluffer. He's a negotiator. So you got to take for a piece of pudding and a piece of pie of what he says, because a lot of the time it's bluff. So it's not really what he's thinking. It's what he wants the opposition to think.
Great comment, Brett. Sorry to end with such a silly question. But yeah, to you both, thanks for the great work that you do. And thank you sincerely for your insights today. Sure, it's going to challenge a few, but certainly it's going to give people a sense of what they need to do and the direction they need to take in how they're thinking about this season. So thank you, Brett, first for your time.
No problem, Jeremy. Thank you very much for having us on, and very much enjoying talking to your members. And I know that they very much enjoy being part of Farm Owners Academy.
Thanks, Brett. And Nick, thanks very much, mate, for your comments, and great to see you.
Yeah, thanks. So this is long-time listener, first-time guest, so I just appreciate the chance to come on and have a chat. I really enjoyed it.
Thanks, guys. And there you have it, ladies and gents. I just always enjoy catching up with Brett and Nick. Their intelligence and their insights are so well backed, and they are so informed. And, if succeeding in business is about having a dream team of key advisors around you, I can't think of a better one if you're a serious grower, crop producer in and across Australia. Their clear message, I think, is continue to bunker down, but that there is opportunity for those who are professional enough to move from reactive to proactive, professional enough to set down a clear marketing plan and put some rules and policies in place that sees us active in our grain marketing across the whole year, rather than just reactive and waiting for what might play out at harvest. Encourage you to consider that opportunity they mention. Encourage you to reach out to them for a phone call at any time, and we'll include their details and the research that Nick mentioned in the show notes. Brett, Nick, thank you. We enjoy our partnership with Market Check. We feel very values aligned. We're all very much and only about the success and prosperity of farming families across Australia. So thank you so much for your openness, for your sharing, and for all the great work that you do.
Thanks for listening to another episode of the Profitable Farmer podcast by Farm Owners Academy. If you're new to this show, be sure to follow us. If you've been a long-time listener, let your friends know about us, or come continue the conversation in the Profitable Farmer Facebook group. All the best as you grow your business and create your freedom farm. Until next time, keep being incredible.